Mortgages and home equity lines of credits are great financial tools that help owning a home easier. But are you using those two tools efficiently together? Hi, I'm Jackie. I help make Canadian business owners' goals a reality with innovative financial advice. In this video, I am going over the basics of a mortgage and a home equity line of credit, also known as HELOC for short. I will share how a business owner can use them efficiently to save on interest and potentially pay less taxes. So what are the differences between a traditional mortgage versus a HELOC? If you bought a home with borrowed money, then you're familiar with what a mortgage is. A mortgage is a long-duration loan secured by a property, typically taking 25 or 30 years to pay it off. Every monthly payment requires you to pay a part of the principal and all of the interest. A mortgage can be variable or fixed rate. This simply means you can choose if the interest rate of the mortgage either changes with the prime rate if it's variable, or it's locked in if it's fixed. The interest rates on a mortgage are often lower than a HELOC, and the monthly payments are predictable. A HELOC works a lot like a revolving line of credit and uses your home equity as collateral. Home equity is the difference between your home's value and the outstanding amount of mortgage and other loans. Think of HELOC like a credit card. You have a limit and you can use none of it or all of it. If you use any of it, you must pay the interest for that month. So your minimum payment is just the interest for that month. It's up to you how much of the principal amount you want to repay. In other words, you don't have to pay down the balance if you don't want to. Now, there are both risks and benefits with a HELOC. First is the interest rate. A HELOC has interest-only payments. It allows you to pay the least amount of your money for your debts, since you are only required to pay the interest, versus a mortgage requires to pay both the interest and the principal. However, the HELOC are always variable, and it typically starts with prime rate plus a premium, usually around 0.5% or 1%. With the recent interest rate increases, you may have noticed your HELOC payments going up rapidly. Secondly is the debt structure and load. HELOC is a revolving line of credit. It allows you to borrow back anything you pay down right away. It could be a great source of emergency fund or unexpected expenses. This frees up the money in your savings account to be invested. When you have money sitting in your savings account, it doesn't earn much interest. Instead, use the cash in your savings account for proper long-term investment, and if the emergency comes, you can access your money from the HELOC. Then you can liquidate the investment to pay off that HELOC balance. Now, keep in mind, the nature of a revolving line of credit can also be risky. It's easy to rack up debt since you're only paying off interest each month. When there's no requirement for principal payment, you can be caught in a situation where you continue to increase your debt load and can feel a cash flow crunch if it's mismanaged. As I like to always quote, debt is like a superpower. With great powers comes great responsibilities. Now, how do you use a mortgage and HELOC properly to maximize its benefits? You'll want to use a mortgage and HELOC together. Mortgages typically can borrow up to 80% of the value of your home, but with the added risk of a HELOC, you can only borrow 65%. So what you get is 65% as a HELOC and 15% as traditional mortgage. Meaning on a $1 million home, you can have a HELOC for $650,000 and $150,000 for traditional mortgage. The $650,000 HELOC has two parts. First, it acts as a traditional mortgage with what the industry calls installment portion. Meaning just like a mortgage, the installment portion requires a principal and interest payment, and the interest rates can be variable or fixed. Each month, you make payments on the installment portion. The principal amount that you paid off would be available for use right away in the HELOC again, but this time as interest-only payments. Once you have this set up, you now take your cash and pay down the installment portion of the HELOC, because whatever you pay off can immediately be accessed again through the revolving part. Therefore, there's no need in keeping money in your savings account anymore, since it earns you low interest and is fully taxable. Instead, now you have the least amount of debt owing, and so you're saving on interest and not paying interest income on your savings account. When you have an outstanding mortgage and a savings account, you're essentially paying interest to the bank to have access to your own cash. Let's build on this idea for business owners. So first, you need to pay down the HELOC with all your income each month. And when bills and expenses are due throughout the month, you use your HELOC's revolving portion to pay off those bills and expenses. You repeat this process each month. As long as your expenses is less than your income, you're paying it down gradually each month. But you're always owing the least amount of debt as you possibly can be, and that will save you in interest. With less interest, you're also paying less income taxes as a business owner because you don't need to pay yourself as much each month. It may only be a small difference in the beginning, but it all adds up over time. Another great way to save on income taxes is the use of HELOC as a form of income near the year end. Here's an example. December is one of those months where we tend to spend more money on vacation, gifts, and in general, more entertainment. If you got a sizable income for that year, why not defer that income for the month to January? So for a month, you cover your spendings with the HELOC, and in January, you take out the income from the business to pay off that higher HELOC balance. This could keep your tax bracket on average lower than just taking the money out of the company and paying yourself a higher personal income taxes for that year. So there you go. As I have said, HELOCs are great when properly used, but they can also be a big spending trap when you get disorganized. We show business owners a clear cash flow plan that keeps this in check, and throughout our financial planning process, we explore this strategy to help you save the most on taxes and interests. Thank you for watching. Are you ready to achieve your goals with a customized financial plan? Take the first step by booking a call with the link in the description below.